Welcome back guys to another Zero DTE video, and today Coach Ernie is going to be talking about butterfly trades, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to join the world's #1 Zero DTE trade destination. Enjoy guys.
So I'm just trying to figure out some of the butterflies and so forth and asymmetric ones. So I wanted to put on a butterfly so I wanted to do out of the money. It was an SPX one. SPX was at 5604. I had I don't want to say a good feeling, but I guess there were indicators that made me feel that or think that the market was going to go up on Friday. So I'm like, okay, I'm going to try to do this. So I started with, we're at 5604. So I went to 5620 and then 40, and I was trying to figure out like my center point and where to get it. And with a 30 wide fly, the closest that I could get was like $3.90, which is more than 10%. I'm like, crap, this is not going to work. And so I tried to go out further, and I'm like, holy mackerel, how far out do you go? And then it wasn't working for me. And then
that's because you have not yet accepted how far you have to go out.
Okay. Like I looked at it at one point and it was at $9, and I'm like, crap, this is interesting. So right now with SPX at 5680 something, I think, how far out should I go just to try this? Like I looked at 5710. Do I need to go further out than that?
You go out until you get at most 10% of the width,
and you just keep moving move the whole fly, move your wings and everything. So keep all of that constant and just keep going further.
Everybody, is that what we do?
Pretty much.
Yep,
yes. Even though it seems like you're going really out far, you'll be shocked that it hits it a lot.
Yeah. So like I said, you have to first develop the acceptance of what the strategy is. First of all, we're not trying to get inside the butterfly. All right. So there's the first revelation. A move that gets into the butterfly only happens about 12% of the time. Most of the money is made outside the butterfly. If it goes the other way, we don't make any money. Those trades typically go 100% loss. You may think, why would I want 100% loss? If you cannot take the 100% loss, then you're trading way too big. Then maybe you shouldn't be trading the SPX, or you need a bigger account. The idea is that the amount that you're putting into each position should be really small compared to your account size, typically around 0.5% to 0.7%, maximum 1%.
You said there's an exception for smaller accounts.
Yeah, when you get to a smaller account, it's harder to stick to that 1% standard. You can go a little bit higher. That's true. But it depends on how small you're talking about. I think once you get up to about 20,000 or so, you can definitely stick by that same standard you can at 100,000. But once you start going a little lower than that, it becomes a little bit more difficult. But you're still putting it way out of the money. Our intent isn't to get it inside the profit tent, although that's what we would all love to happen. It's just that it's a probabilistic event. We know that most of the time, we're going to just get enough profit that will offset the losses. And we're waiting for that 12 or greater % of the time that it does get in the profit tent, because that's what's going to move the needle in our account and raise it up. The rest of the time, we're going to be making enough that we're not losing. That's the key.
And that's the 25 to 50% profit.
It can be quite a bit more than that. Generally, the range of profits that you make when you're outside the butterfly can be anywhere from 25% to as much as 250%.
So you don't want to necessarily set a profit target. You just have to babysit it in the morning? Okay.
Yeah, it's not really babysitting. You're looking at it and you make a hold of full decision. And if it's not there, then you look at it a little later and then decide what to do. But generally, we have a profit management framework that we set, which is like a dynamic trailing stop. And the dynamic trailing stop starts out in the beginning of the day very wide. And then as the day moves on, it gets narrower and narrower. It's getting narrower at the same rate that premium is decaying and gamma risk is increasing. Now, over time, you'll get used to be able to do that just off the top of your head, because it's not like a steady state trailing stop. You can't keep the same trailing stop all the time. It just won't work. It might work every once in a while, but you're going to be compromising your account too much. So you want to try to capture as much profit as you possibly can while you're there. And if it does happen to get inside the profit tent, you want to be able to move with it. And most trades that you're in are going to last a couple of hours, 2-3 hours. And occasionally, if they go later into the day, then you know that you're going to be making potentially a lot of money on your risk. But it will result in two things. It'll result in minimizing your volatility of your returns. In other words, keeping your drawdown very low and keeping you in the game, and then maximizing the return on capital that you get. And so that means that you're going to be stepping up with very little volatility and just have a nice, consistent move up. That's the ultimate expression. That's where you want to be.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit the subscribe button and the like button below. If you're interested in becoming a pro trader, remember to check out the link in the description for Ernie's school community.